Good evening, everyone, and welcome to our Wednesday weekly webinar. Thanks for joining us. And this is our fourth webinar of 2026. My name's Andrew Segal, and I'm managing partner here at Joseph Mews Property Group. And we're going to look at how smart UK property investors build property portfolios without overpaying tax. I think with any investment, you want to maximize, we talk about gross yields and net yields, but it's all about maximize it, getting the most, squeezing every penny out of it, whether that be the right property in the right location with the right capital appreciation and the right rental yield. There's all these ancillary services which are important, like tax, that can make a big difference to your net return. I'm joined by Amy Richardson, director at Flow Advisory. So she's going to do the heavy lifting. I'm just going to run through a couple of slides with you shortly, just to give you a bit of background, because I can see on us, because I can see we've got a lot of new new clients on and new potential investors as well. All our previous webinars are on our Joseph Mews YouTube channel, and they focus on different areas of investment, location, obviously tax today, mortgages, everything that you're going to need really as a newbie or a sort of seasoned property professional. On the bottom of your screen there, you'll either see a Q&A button. Mine's disappeared. I think you have to click on the more. Yeah, click on the more, and then you'll see a Q&A button. We found sort of one of the best elements was the Q&A session. So we'll have myself to talk property in general, anything in particular, and obviously we'll have Amy to run through. There might be some sort of specific questions, but I guess if we can sort of keep it more generic, and then there'll be an opportunity to click on a box at the end to either talk to myself or someone in the team about property or the market, or more importantly about Amy to talk for any sort of specific taxation questions that you may have. And as I say, sit down, relax, grab a pen, think of, we should cover quite a few bits and bobs as we go through, but have the Q&As ready, and we'll cover that at the end. Just as I say, a lot of new attendees I can see, so thanks for attending. We'll try and keep it to around half an hour or so, depending on the Q&As. But just a bit of background. We were founded by Andy Foote, who's our chairman, sort of early 2000s, and he bought a lot of off-plan property back in the day. He bought some stuff that was overseas in Spain, and the customer care wasn't good. He's still got the property today. It's trebled in value, as most property has since the 1990s. But the customer care and the experience wasn't very good. There was sort of not a lot of communication, transparency, and guidance. So it wasn't. It was a profitable experience, but it wasn't necessarily a good one from a customer care point of view. So when he decided to set up the company, it was all about putting customers first. And as you'll see, we're a one-stop shop for our clients, everything to do with property. And of course, with partners like Amy. So we cover literally everything with one phone call with our partners. We partner with various developers as well as property companies, and that allows us to access the best stock in the country and give our investors access to the best developments in the UK. Just a little bit of history, as I say, 4,270. It's actually more than that, but more not only marketed and sold, but more importantly delivered. Where we have clients that are building a portfolio, all of those, which is actually 28% of our clients in total, will reinvest with us. We've delivered 44, 45 developments now, and GDV, gross development value, that means we've delivered over £600 million of property. So we've been around a long time, and we're very experienced. I mentioned the issue that Andy had, and we've got a strong, obviously, in-house customer care team. So whether it's off-plan or potentially nearly completed stock, we'll get you to reserve a unit, we'll get you to exchange, and then we've got the whole customer care team. So if it's off-plan, we'll give you build updates. We can help with solicitors. When we get to completion, we help with mortgages. We help with handover. We do the snagging on behalf of the developer. We do all the lettings and the rentals, tax advice with trusted partners like Amy. And morally and contractually, we'll stay with you and the developer, because we partner with the developer because the developer does the build, but they like us, and this is why we do so well because we've got a fantastic history, a good performance in the customer care, the snagging, the after sales. So you're not left like Andy was. You're not left wherever you are in the world, wherever you are in the UK. You're not left floundering. It's one phone call and one person that'll look after you throughout your whole journey. Um, we're more than a property promoter. What does a promoter mean? Well, we partner with these developers and we offer this end-to-end service. So we help investors all the way through their journey for as long as they want us. And we do things like a portfolio review. I have one property, I never put the rent up for 4 years, and it was fine. It was a good tenant, and probably quite a soft touch from a landlord point of view. When I put that property on the market again, I got £450 a month more for it. So we'll help with general reviews to look at things like mortgage rates. I've got a property at the moment. I wanted to buy it. I could only get, because I'm quite leveraged, I could only get 7% mortgage rate. So it was kind of just about breaking even from a rental point of view. However, I got a 2-year fixed mortgage deal. Now I'm on 3.9 or less percent. And so I'll make profit now on a monthly basis. Also, of course, I say, of course, that property has gone up £40,000 in that period. So things like that are really important to maximize. So that's why we do the, excuse me, 12th monthly review tied in with the rental appraisal. And we can tailor investment strategies and bring in partners like Amy, as I say, to really maximize legally, legitimately, mitigate, and make sure you're getting the most out of your development. So I'm going to introduce you to Amy. She's going to tell you how to pay less tax. So let me just click on the next slide, and then I'll come back on. I'll come back on after Amy's done her slides. And don't forget the questions.
Thank you, Andrew. Pleasure to be here once again. So, a bit of background, I am a chartered accountant and a property tax specialist. My firm, we work we work with over 180 landlords. It's definitely more than that now. Developers and business owners across the UK. So we don't just work with local clients here in the Midlands. We also work virtually with a lot of clients over the UK and even some overseas. And today I wanted to focus on a couple of areas really. Some which you may have already come across and some might not be as fresh in your mind. But essentially, what you will learn is the structures used by experienced UK property investors. So even if you're right at the beginning, just having the knowledge that these structures exist and you may be able to grow into them eventually, that's the whole point of having that discussion. We will look at incorporation planning. And when I talk about incorporation planning, what I mean here is when we're moving property from personal ownership into a limited company. So if you're already a landlord and you have properties in your own name and you're being hit with a high tax bill because you have to do a self-assessment, which is due in about 3 days' time, please chat to me at the end about that. So we'll be covering that. Then we're going to look at group structures, which is basically a limited company structure, but a more advanced version, and as to why you would use that. And we will also look at IHT planning. So IHT stands for Inheritance Tax Planning. And by the end of that, you'll probably all be asleep. But hopefully we will have some good questions in the Q&A, as I feel that's where people get the most value. So please get your pen and paper ready as I whiz through the slides, and I'll take your questions at the end. Let me just do this. Just some general housekeeping, then I won't stay too long on this one. It's just general guidance. This is not a personal tax consultation. However, if you do want one of those, there will be a link at the end for you to be able to book in with that. Like I said, I'll keep an eye on the Q&A, but we'll go through the questions at the end, and keep that pen and paper close. So why are we talking about tax? Why are we talking about tax specifically in relation to landlords and property developers? Well, for most property investors, unfortunately, they pay way more tax than they should. A lot of this you may have heard is due to what we call Section 24. So Section 24 is basically years ago the government decided to change how they taxed rental profits on landlords that own properties personally. So now what's happened is a lot of landlords are ended up paying tax on overinflated profits. So before you used to be able to get all of the mortgage interest to come off the profit, and now you only get a tax credit of 20% against those mortgage interest costs. So over time, that's inflated what we call an artificial profit. And let's say if you've got a day job and you're already a high rate taxpayer, we've actually seen through some self-assessments that some clients have been paying tax rates of 60 to 85%. So it is kind of horrendous, and that's why we need to talk about it. I've put here no long-term succession or IHT planning. Unfortunately, with property, people have a long-term view in terms of the portfolio. They know it's going to go up in value, but what they don't tend to think about is the tax effect on that. And particularly when we get to certain ages and we want to think about passing on that portfolio to the younger generation, that's when we need to start thinking about inheritance tax. And that's why we're going to talk about that today. And lastly, the point on here, smart investors don't buy more properties, they change the structure. So what we're really thinking about there is maximising your returns. So through blocking any tax leakage, we can make sure that you keep the right amount of cash within the properties, within the structure that you're in, and essentially you'll have more cash flow to go and expand your portfolio. So this is the typical investor journey that we see. So the first obvious thing is you've got to buy a property. And a lot of people just go and buy it personally. Even though there's a lot of talk about limited companies online and investing through a limited company, we still see so many people buying through their personal name. And I would assume one of the main factors for that is because the finance is cheaper on a personally owned property from a mortgage interest rate perspective. So let's say you get one property and then you start, you might do a refurb on it and then you might refinance it to go again. So you end up growing the portfolio. And before you know it, you've got a massive tax bill. And what happens then? You've got tax leakage. So the growth slows down. Then you start to panic and think, what am I going to do about this? And the last point there, saying that the issue isn't the properties, it's the structure. And in this particular case, if we go back to point one, if you'd have bought those properties in a limited company, then you would not have had the tax explosion, the growth slowdown, or the panic. So if we are thinking about buying property, obviously you need to take personalised tax advice, but do think seriously about using a limited company. So like I said, these are the three core structures we're going to cover today. Moving property from personal to limited company. So this is where we have a personally owned portfolio. So you've already got, say, 4 or 5 buy-to-lets in personal name, and you know that a limited company is better for you, and you want to see if it's possible to move those into a limited company. Then we're going to look at group structures, which is a more advanced version of a limited company and how you would operate that. And then we'll look at some long-term family and inheritance tax planning. So why would an investor incorporate their portfolio? Well, the key drivers here are the corporation tax that you pay in the limited company. The rate is a lot lower than income tax. And I'm comparing that to income tax rates for people that are already high rate taxpayers. So for example, you might be a 40% taxpayer, and if you hold the portfolio in a limited company, the maximum amount of corporation tax you're ever going to pay in the company is 25%. So there's an immediate saving there. And in the company, we can take off all of that mortgage interest, whereas we can't in our own name. You would also have retained profits to reinvest. So obviously you've got more retained profits because you've already paid a lower rate of tax because of being in the company. As a result of that, we have improved cash flow. You can scale the portfolio quicker. And in certain situations with lenders, etc., it can position you more of a professional investor, portfolio landlord. So we've got a note here to say personal ownership equals income extraction taxed heavily, and company ownership profits can be recycled. So if your goal is to grow the portfolio over time by buying more properties, then company ownership is something that you'll want to take seriously. So we've got an example here just at a high level. So under personal ownership, so rental profits can be taxed up to 45%, 45% being the additional tax rate. Now, it is actually more than that on some portfolios, because if you've got earnings over £125,140, then you start losing personal allowance. So the actual tax rate, the effective tax rate that you would pay is actually higher than 45%. We know the mortgage interest rate is restricted, and it is an absolute growth killer, unfortunately. On the other side, we've got limited company. We know for a fact we're only ever going to pay maximum 25% on those profits. We know that we can definitely take off all the mortgage interest, and the retained profits are reinvestable within the company. So we've got more cash flow. So I've put here the biggest fear: stamp duty, land tax, and capital gains tax. Now, I'll just explain incorporation and just generally transferring properties over. So a lot of people think, oh, I can't move my portfolio because I've been told by my accountant that I'd have to pay stamp duty on the market value of the properties. And CGT would be horrendous. Capital gains tax would be horrendous because let's say you've owned those properties for 10 years in your personal name, because 10 years ago, it made sense to buy them in your personal name. With the incorporation route, it's a certain type of planning, and there is a tax relief, section 162, called incorporation relief. And what that relief does is it basically gets rid of the capital gains tax element. So you could, through the incorporation process, usually with the partnership. The reason for the partnership is to get rid of the SDLT as well. You would effectively end up transferring the whole of that portfolio without paying stamp duty, land tax, and capital gains tax. However, and there's always a however with this, it is very complicated planning. So you must take professional advice. You must look at it from a commercial standpoint as well, with mortgages and stuff, especially if you've got finance on a personally owned portfolio of properties. You must look at the financing element of this, and also the legal side. So incorporation relief is not automatic in the sense of you can't just do it. You have to take the advice on it, because what we're finding now is that HMRC are investigating more into property limited liability partnerships and property limited companies as a result. So, for example, if you did an incorporation, we would have to put on the tax return that goes in that this is an incorporation process. That then opens up HMRC to have a look at it. So you need to make sure that you match all of the criteria in the legislation, of which I'm not going to go into loads of detail today, but there are specific things in there. The main thing is that you must display that you have a property business. So think things like you must potentially self-manage the properties. You must have a certain amount of properties. Basically anything to give that point of view that you are running a business, and that it's not just investment properties we're trying to pop over into a limited company, because then HMRC would say, no, you shouldn't have incorporation relief, and actually you've got to pay all the CGT. So some common incorporation mistakes that I see every day, and I'm not joking, it is every day, because that's how much I talk about this stuff. So a lot of questions, people say to me, well, can I just move some of the properties over? Technically, the answer is yes, but the practical answer is no. because incorporation relief is an all or nothing relief. So you must move all of the portfolio that's owned personally into the limited company, because don't forget, we're telling HMRC that it's a property business. So you wouldn't just move half the business. If it was a sole trader, for example, you'd have to move all of it. So it's the same concept that applies there. Another mistake that people make is that they ignore mortgage consent. So we've had some people come to us, they've done an incorporation with another advisor and they've actually committed mortgage fraud. So obviously, I'm going to hammer home the point of, when you're looking at this type of planning, everyone has to be on board. Mortgage advisors, brokers, legals, tax advice. You have to have everyone involved in this complicated planning. We've got points here: poor ownership splits, transferring at the wrong time, etc. These are all just other odds and sods that come through that I see on a regular basis, but the main ones are the top two that I've just spoken about. The last point, saying bad incorporation costs hundreds of thousands, it literally can, because we've had people come to us that have used tax avoidance schemes, and effectively that planning was null and void by HMRC, and HMRC made them pay all the tax back and fines and penalties. Hence why I'm saying get a professional opinion in writing. That's the best thing you can do, because effectively that becomes your insurance. There's a lot of advisors out there that are not prepared to put their point of view in writing, and that is a massive red flag. So please don't fall for that one. So we're going to talk about when incorporation usually works best. So it's when we have multiple properties, it's when we're thinking long term, so we've got a long-term hold strategy. We're definitely a higher rate taxpayer, because I guarantee that's the number one thing that's making you want to move them in the first place. You generally would have quite a high portfolio value already, because naturally you would have multiple properties. So the value of those properties in most cases is nearing a million or so. And of course, if you're looking at this type of planning, you are a growth focused investor, because you understand that you want a better return on the portfolio that you've got. I'll just round up before we go into group structures on incorporation planning. Let me just go back one slide. So obviously it's all good and well saying that we can do this type of planning. The other point to note on this is that it only really works if you can do it in a partnership as well. And the reason for that is, if you are operating your portfolio via a partnership prior to incorporation, then due to the tax law and legislation we have in this country, when that partnership gets incorporated, because of the rules on partnerships, you will not pay any stamp duty land tax. So that's a very important point. So what generally would happen is, we'd have a client come to us, we would talk them through the current situation, we would then do a written paper to say, based on the current situation, this is our opinion on the availability of incorporation relief. And if we think that that position can be strengthened, we'll then provide a step plan to be able to get you into that best position before going for the reliefs. And 9 times out of 10, that may involve, for example, setting up a partnership. And that's mainly because of that stamp duty land tax element of moving the portfolio over. Right, so moving on to group structures. Now, I'll continue the theme of, let's say we had an investor that wanted to move properties into a company. Now, let's say they've actually managed to do that free of tax. So happy days, they've got all their properties within one limited company. But let's say the same investor now wanted to start buying different types of property. So maybe HMOs or doing joint ventures with people, etc. In that case, they would then want to think about having a group structure. And what this essentially means is, you have your normal limited company with your properties in. So ideally, they'd all be buy-to-lets in one company. And then what we would do is we would put a holding company on top of that property company. And the reason we would do that is we've got a portfolio, it's earning profit, it's being taxed at a nice rate, and we've got some reserves left over, we've got some cash flow left over. We want to try and get that cash out and into other investments in the most tax efficient way. So the most tax efficient way to do that would be to put a holding company on top of the property company. And then the excess dividends that we have within the subsidiary company, the company underneath, we are allowed legally to send that money, if you like, that dividend up to the holding company completely free of tax. Now, compare this to someone who had a standard limited company and to reinvest into different types of properties or another business, whatever it might be. Let's say they took that out as a dividend, it would have got taxed on them personally. So they would probably be paying rates of 39% plus on those dividends. So just by having that holding company on top of the subsidiary, you are allowed to do that at 0% tax. So therefore, keeping that cash flow at that level and enabling you to reinvest it around the group tax-free. All tax things aside, another really good reason to have this structure in place is asset protection. So if we've got different types of properties or we've got a specific exit route for one of the properties, then this would provide asset protection on those companies. So you're not mixing trading activity with investment activity or anything like that. Because some of you may also have businesses as well. So I would never advise somebody to start buying a portfolio of properties within the company that they trade from, for example. So I've basically just said all of this. Why would smart investors use groups? Again, asset protection, risk separation, lender flexibility, profit extraction without dividend tax, which is what I've just explained. So as long as we're keeping the money within the group structure, that can be done at 0% tax. Clean exit planning, not just from a business owner perspective, but also from a selling a property perspective. Because, for example, if you have one property in a limited company underneath the holding company, if you found a potential buyer, they could buy the company rather than the property. So what that then means is that the buyer would only pay stamp duty on the shares, on the value of the company, and they would not pay stamp duty land tax rates. So this is why sometimes we have people come to us saying, should I have one company per property that I buy? The answer to that is it depends, and it depends if you think you're going to do that type of thing. If you're not, then there's no reason why you should do that. If you had 5, 6 buy-to-lets, keep them all in one company under the holding company. Otherwise, your accountancy fees will be ridiculous. So I've got a note there saying groups are not complicated, they're strategic. That's quite easy for me to say because I do this all of the time, but appreciate you're getting a lot of information at the moment. So if you do want to have a conversation offline around group structures and why it might be right for you, then obviously just let me know. But also it's worth noting that anyone who's big in property, any of the big businesses here in the UK, they will all have a holding company because they are all adapting that same strategy of keeping everything within the group and recycling. So we've got an example structure here. So we'd have a holding company. So you personally, as the shareholder and director, you would own 100% of the holding company. And that's the only company you would own. And then underneath the holding company, we potentially would have property company number 1 that might have buy-to-lets in. Property company number 2 might have HMOs, and property company number 3 might have developments. But the main point here is all of these three property companies are owned by the holding company. And I've got a note there to say that profits flow upwards tax-free. So essentially, if you want to scale your portfolio as quick as possible, having the holding company group structure in place will allow you to do that. Because, like we said, the dividend tax every time you extract profits, if you to do that personally, that just doesn't make sense. We can do the intercompany dividends at 0% tax. So you're enabling yourself to put the cash flow through the business and get a better return on the portfolio. And obviously that means you have more cash to go again and buy the next property. I think we're done. We didn't even get in time for inheritance tax.
Well, I'm sure I can see some questions coming in, so I'm sure we'll have some of those in a minute. Thanks for that, Amy. I'm old and I've been investing all my life, and it's still, it's a bit of a black art for me, and it's always good to have, a specialist that knows what they're doing, which is why we partnered with you. We have, I think, looking at what you said, we've got, it's sort of, different, maybe different SPVs, different companies, and sort of building a portfolio. But we're seeing in the UK, I think it's something like 75% of we've got a lot of portfolio investors, some with hundreds of properties, and we've got a lot, probably 50%, they're just sort of first time buyers, and they might have one property. So you've got putting a property in a limited company will also give you benefits when you're drawing out dividends, capital gains, inheritance tax. So there is, even if you're a smaller or a one-off landlord, there's still big benefits looking at it that way around. And again, we have a lot of overseas investors that can take advantage of this when they're coming into the UK because they're buying, they're investing through a limited company. And we can, as I say, easily set that up and manage that. And again, don't have to be a UK client. You can get mortgages, etc. The UK is the most invested country in the world for overseas investors. So that limited company structure be good. You can get mortgages. There might be difference in rates, but then that can be offset by, you're pulling out, you're structuring everything that in a tax-free manner for you now and for, succession planning for children and things like that, depending on what you want to do. And there's a clear exit strategy as well. If you haven't got kids or don't want to give it to them and want to go to Vegas and spend it all there. So I think it's just a nice sort of flexible solution. So that one-off company thing again is worth looking at as well. So I can see the questions come in. I'll be with you in a second on those. So thanks for those. While I've got you there, we're a property company, as I say. We partner with developers. We've got developments in Birmingham. We've got number 30 St Paul's, which is the flagship in Birmingham. We're headquartered. The UK headquarters is in Birmingham, and it's massive regeneration. It was voted by PricewaterhouseCoopers, JLL, Knight Frank, Savills, the number one place to invest in the UK. Why? Best capital appreciation, best rental yields. We've got Derby, we've got prices from 148,000. We've got Leeds commuter belt from 164,000. Some are off plan, some are ready to go. And your sort of requirement is if it's off plan, it's 20% deposit. And then we can do 75% loan to value mortgages. So again, something else, which is what I call good debt. Yes, you might have the cash to buy a property, but it's always good to leverage. It's tax efficient, as we've seen from a mortgage point of view. And, instead of buying one property outright, you can buy four, you can leverage it, etc., etc. I think that's, as we all know, hopefully the basics of sort of property investment. We've got Birmingham again. We've got the Point in Wakefield, fantastic little development, little cinema room, boutique development, prices from 179, and other Birmingham options as well. We tend to have the developments I've mentioned before, the 45 or so that we've delivered. About half are in Birmingham, so we're very experienced with the Birmingham market, and again we have lettings partners, etc. there. So again, there'll be a button to click. We wanted to make it more about the tax information. So again, there'll be a button to click in a second once we've gone through the questions, and then we can pick up on anything you want to find out about the market, mortgage interest rates, particular developments, etc. So from our point of view, what does it take to be a Joseph Mews client? Obviously, we want you to be actively seeking UK property and UK property portfolio and UK growth, are open to expert-led investment guidance. We're old. We've been been doing this for many decades, and we work with the best developers in the best locations. Typically, I mentioned 20% deposit, so you're going to probably need about access to about £40,000 in cash to invest when we're looking at things like stamp duty, etc. But again, and you can leverage that with a 75% loan to value mortgage. We want you to have hopefully a long-term sort of growth focused mindset. Again, if you completed on a development or an apartment today and had a problem, it's fairly liquid. We can sell it for you. We do sell client portfolios as going concerns. So we're selling a ready-made investment. And really, we like to understand, as Amy does from a tax point of view, understand our clients' goals. Is it more capital appreciation? Is it more rental yield, etc.? So again, click on the button and we can always spend more time with you and run through them in detail. Got a special offer for attendees only. We can track you. So if you buy in February, I think it is now, or reserve £1,000 towards your legal fees and furniture packs. So yeah, again, we'll know and we'll be able to track you back from there. So just a little incentive there for you coming on this evening. Next step, we'll go on to the questions in a second. I'll call those up now. But if you would like a free property consultation to talk anything to do with UK property, tick the box. If it's for Amy on the tax consultation side of things, tick the middle box. And if you're just browsing, that's fine. But just tick the bottom box. We'll keep you updated with the regular webinars. We do them weekly and events, etc., etc. So let me come on to the questions, which I'm assuming probably all for you, Amy. So I've got the first one. Hi, Katie. How are you doing? I did drop you a message today. Am I right to say if I have a holding structure, one parent and 3 subsidiaries, then I will have to file 4 sets of accounts?
Yep, because every single company is a limited company within that structure.
Lovely. Nice and straightforward. Thanks for that. With regard, that was Katie. Abby, thanks for your question. With regard to transferring a property portfolio into a limited company, how long would the partnership have to exist to meet HMRC rules?
2 to 3 years.
Okay, fantastic. Olatwanian, are you sharing the slides with us after this session? Yes, we will. We'll send the slides. And then I've got Philip, please contact me offline. Yeah, okay, we'll come to you on that. It's a particular question. You're living overseas, SPVs, not yet. Okay, fantastic. Let's, I'll make contact with you tomorrow, Philip, have an outline chat, and then we can involve Amy as well if we need to. So that's good. So thank you for the question. Hi, Reese, how are you doing? Nice to speak to you again. Hi, Andrew. You mentioned leveraging the stamp duty. Does this mean we can add this onto the mortgage as we're currently saving this? I think the answer is no, isn't it, with stamp duty? Because leveraging, when you get a mortgage, but you can't mortgage your tax, can you? You can't mortgage your stamp duty.
No.
Okay,
the mortgage
perfect.
is on the market value of the property, isn't it?
Yeah, so you'll have your mortgage. Obviously, Reese, I know, we've got Sarah and the team there. So with mortgages we're helping with, but yeah, stamp duty will be a separate payment that you'll pay to your solicitor, your lawyer, and then your solicitor, I think they give you, the last one I did give you a few days to pay that, and they'll pay that on your behalf. Okay, Alex Lee. Alex, thanks. How do I choose both consultations, property and tax? If you just tick the property one, that's fine. I'll make a note, Alex, and then I'll have a chat with you first, or one of the team. I'll try and make it myself as we've had a bit of contact, and then have a chat with you, find out a little bit more, and then I can introduce you to Amy. That makes sense. Another question. Do you manage properties for an investor after the sale, or do you have recommended partners? It's a bit of both, actually. As I mentioned earlier, we're a one-stop shop. So we do everything for the developer. Developer gets on and builds. Then we do all the sales, marketing, which is the easy bit. The customer care is all down to us. So yes, we have recommended partners, like letting agents that we've been working with in Birmingham for many decades. So yes, we will manage the whole process. We'll put you in touch with recommended partners, and those recommended partners offer reduced rates as well. Mossadegh, how do you calculate profit on a rental property? Well, we have cash flow summaries. So if it's an we have detailed cash flow summaries. So we can look at all your costs, stamp duty, service charge, etc., etc. We can put in all your costs and fees, and then we come out with a gross. But more importantly, after all your mortgages, if you're mortgaging, we can give you a sort of a true net return. So we look at percentages, and then we can. I did one for someone today. They were putting in 50, 60,000 pounds. They were leveraging 75% mortgages after all their costs, fees, and charges, and they were £300 or £400 a month, sort of cash flow positive. So maybe tick the property consultation box, and then I can talk to you in detail about that one. Okay, one for you, I think, Amy from Evadne. Thanks. If I have a property portfolio owned jointly with my spouse, but one property is owned partly by one adult child, they own a third, will that make incorporation impossible?
The answer is it depends, because it depends how many properties we're looking at. It depends on what work is going into the portfolio. So that's a case that we'd need to look at offline, and effectively we'd need to take the legislation against your specific criteria, if that makes sense.
Yeah. Yeah, like with anything, because we've got some clients that are overseas buying a property, they're not paying tax in the UK, so they've got their tax-free allowance. And sometimes it's beneficial not to put it in a limited company. But again, we can talk to people because everyone's sort of individual circumstances are different. Matthew, to gain incorporation relief from personal properties to limited, why does it need to be an LLP and not just move from personal to limited if 50% time in the business, etc.? Does that make sense?
Yeah, absolutely. It needs to be in a partnership, because otherwise you would end up paying stamp duty on the incorporation.
Cool. Okay, lovely. Thanks for that. Saju, at what stage of property journey do we start the limited company, and how complicated is it to manage this as a beginner?
I'll take that one.
Thanks.
If you are already a higher rate taxpayer, then a limited company will be far more advantageous for you. I wouldn't say it's complicated to manage, because you effectively just hand it off to an accountant. And if you've only got one property in there, there won't be much for you to do other than send the bank account to the accountant at the year end. That's also something we can help you with. So not just the tax advice that we do, but we also have the accountancy arm where we can do tax returns, bookkeeping, and setting up of companies and the accounts and things like that.
Yeah, if you've not bought yet, it's easy to set up a limited company. If you've reserved but not exchanged, again, we can help there. If you've exchanged but not completed, something you've already bought that's off plan, you've put maybe your 20% down and you're completing at some point in the future, then there'll be some legal fees to pay, because you're reassigning the contract from yourself, from your name, to a limited company. So it depends on the developer. Do they allow reassignment? Obviously, we do with all our developments. So again, tick the box on the tax consultation or the property one. We can have a chat, understand what you're looking to achieve, where you are within that journey, and we can make the right recommendations or pass you on to people who are qualified to make the right recommendations. Thanks. I think this might be the last question. Steve, thank you, Steve. If I'm working and paying a personal tax, PAYE, does that affect my limited company tax on my property?
No, absolutely not. You are not your limited company. The limited company is a completely separate entity and therefore is taxed in its own right under the corporation tax rules.
Lovely. Thanks for all the questions. Always good to make it nice and interactive. Thanks, Amy, for explaining it in a way that even I could understand it, I think. But again, tick the boxes. I'm sure you have. We'll get the numbers in shortly. What are we? Yeah, 7:45. So we'll probably be in touch in the morning. Hopefully, if it's property, it'll be myself. If we had a lot of people on tonight, so it might be one of the team, but I'll try and come back to you. And we'll do the same with Amy and her team. They'll be in touch as well. So just want to say thanks for Sanjana. She's over in our Dubai office running the slides for us. Thanks for Amy, who's over in the UK, and myself. So, yeah, thank you, everyone. And hopefully, we'll speak soon and see you on future webinars.
Thank you.
Thanks a lot. Take care. Bye bye.